What's up, guys? My name is Austin, and you're watching Econometrics with Austin. Alright, guys, so we've got big news today, really big news. So today the Dow Jones Industrial Average had the worst day in history. The Dow fell by 2,997 points in a single day. The worst, this is the largest drop in points in the history of the Dow, and the second largest drop percentage-wise at 12.93%. Can you imagine? Like, it's unfathomable that the Dow Jones Industrial Average lost almost 13% of its value in one day. One day, that's absolutely crazy. A lot of people predicted that we would have losses today, but I don't think anybody predicted that the losses would be this big. 13% in one day. Absolutely crazy. So, what is causing all this? There's multiple things that are causing this downturn in the economy. And obviously, the number one thing is the coronavirus. That is the thing that is causing all of these problems. So as it's spread across the world and the entire U.S., industries are slowing or shutting down. Just look at hotels, travel, entertainment, that type of stuff, slowing down. So what we've got here is a screenshot of graphs. The top graph is the S&P 500 value, and the bottom graph is the unemployment rate. Can you see the gray boxes on the bottom graph? Those are recessions. And as you can see, during a recession, unemployment rate goes up.
Okay,
and
I found this on the web for what do you see me gray boxes on the bar graph as a recession?
Siri,
check it out.
Siri, shut up. Anyways, like I was saying, the gray boxes are a recession. And as we go into recession, unemployment rate goes up, stock market goes down. So currently, as of 3/12, that's how it's updated, you can see the stock market, the prices are starting to fall. As these industries, restaurants, hotels, as they start to lose business, they will start to lay off people. We don't have that yet. We'll probably see the unemployment rate tick up into the next data that comes out for the month of March. That should be in the beginning of April sometime. We'll see that bump in the unemployment rate. But you can already see the stock market is falling. You know it's falling. So higher unemployment leads to less consumer spending, and less consumer spending lowers profits. And what drives the value of the stock market is the performance of a company. So expectations are what drives the stock market. If you expect a company will do good, will perform well into the future, that's what drives people to buy stock. Because the better the company does, the higher the value of the stock will be, meaning more money for you. So this is one of the main causes of this downturn in stock prices is the coronavirus, and then you compound that with shutting everything down. Higher unemployment causes lower consumer spending, which causes lower stock prices on top of them already dropping because of the uncertainty. So we've got a lot going on, and it's, the volatility right now is absolutely insane. The volatility index is at the highest it's been in a long, long time. It's at 82%, 82 percentage points. And then also last night, the Fed cut the interest rate down to 0%. And normally you would think of that as a good thing. And it is a good thing, especially for people needing money. People needing loans, this is great. But the root cause of this downturn is not a market cause. It's not like in 2008 whenever it was the financial and housing crisis, and lowering the interest rate helped people to buy more houses. That helped to kind of solve the housing issue just a little bit. But that's not what we're seeing. This is a panic. And it's all due to the coronavirus. So people aren't sure what's going to happen. And whenever the Fed all of a sudden on Sunday night cut the interest rate to 0%, it really spooked investors. And it sent a mixed signal to investors that, that we're in a lot worse of a situation than expected, or than that we thought we were in. Investors knew we were in a bad spot. But whenever when the Fed just automatically cuts rates to 0% just on a random Sunday night out of nowhere, that really signals that we're a lot worse off. The economy is a lot worse than expected. So what they're trying to do, or what they've done, is the Fed offered today $1 trillion of repo. And what that is they're buying back T-bills and mortgage-backed loans. And what a lot of people are wanting them to see is them to get into commercial paper. Commercial paper is bonds that are offered by public companies. So say Walmart wants to build their new headquarters, going to cost $500 million. And to pay for it, they issue commercial paper or bonds. And people buy their bonds and they get paid back. But anyway, so this morning the Fed offered out $500 billion in repo. Then this afternoon they offered another $500 billion. And the first $500 billion was great. They accepted. So it's kind of an offer. It's, hey, we'll buy back $500 billion in bonds. This is how much we can spend. They accepted $129 billion this morning, which sent a positive signal to the market. Well, that wasn't enough. The Fed believes that wasn't enough. So they issued another $500 billion in repo whenever they hadn't filled the first $500 billion. And about $19 billion of that was bought or used up. And what that did, that sent another signal to the market that we're in worse shape than we thought we were. It did stabilize the bond market. The bond market is up, which is good. But it's sending more signals that we're in worse shape than investors currently think we are. And also, the new survey came out of Fed governors, and there's now a 67% chance that we're going to go in recession. That's what the Fed believes. And just last month, whenever this same survey, the Fed governors, it was a 41% chance of recession within the next 12 months. So you can see that the economy is not as healthy as we once thought it was, and things are going to get worse. And that's how most things happen. They get worse before they get better. You just have to brace for it. So personally, I think we're already in a recession. Maybe not the economy as a whole. The economy as a whole isn't in a recession, but whenever you look at the travel, entertainment, restaurant, those sectors, they are definitely in a recession. If you look at their stock prices, they've tumbled. I'm looking at the casino stocks, the hotel stocks, restaurant stocks, airline stocks, they've all tumbled. And that's what, I think they're in recession. Economy-wide, maybe not, but they definitely are. And a lot of the analysts are saying that our GDP in Q2 will be down 1.8%. They're kind of predicting it'll be up a little, 0.2% in Q3, and then back to normal, 3% in Q4. I line pretty close to that. That's what I'm thinking. It'll definitely be down for Q2. Q3, depending on how long this virus, it could be negative, could be positive. A 0.2% is pretty good. Then up 3% in Q4. That sounds great. Hopefully that's what happens. And some people out there, they're saying GDP will decline by 5% in Q2. I don't think that's going to happen. They're probably the same people that are saying the death rate's going to reach 1,000 a day in the U.S. That's not going to happen. It's not going to happen. So I personally don't think Q2 GDP will drop that much. I'm thinking it's definitely going to be negative, but between 1 and 2% is where I'm at. Definitely not 5%. So another thing that I think really hurt the market late today was hearing President Trump actually say that it might be July or August before we see the coronavirus contained in the United States. So if we take a look here at the Dow Jones Industrial Average, you can see that today down 2,997 points. Absolutely insane. This is the 1 day. As you can see, there was the trade halt this morning after it fell. And it was pretty up and down, flat, trending down. And about 3:30, maybe 4 o'clock, 3:30 in this area right here, is whenever President Trump first came on TV speaking. And you can see it jumped up a little bit. It seems like whenever he comes on, people really like hearing from him, seeing what he's going to say. There's more optimism. Maybe he'll say something positive. And you see this spike right here. You see this spike. That's when he's talking. That's about the exact time that he mentions it'll be July or August before we're done with the coronavirus. And as you can see, the market absolutely tanked from there, losing about 800 points in 15 minutes. 800-point tank in 15 minutes after it's already down. It's already sitting at 2100 here. 2100 points down. He says it's going to take till July or August to get it under control. And boom, another 800-point drop. Absolutely crazy. And, that really hurt us here at the end, but he's telling the truth. He's not hiding it, saying, oh, we'll be done in 2 weeks. We'll be done in 3 weeks. He's telling people the truth, and that's a good thing. It's best for government to be forthcoming and tell the truth instead of trying to hide stuff, because we'll find out about it and it'll be worse at the end. So, an update from yesterday. Yesterday. On Friday, Trump announced that he was going to start buying oil for the reserves, and he announced that within the next 2 weeks he'll start buying oil to fill in the reserve. And I just want to talk about what all is going on with this oil price war. And as you can see, and so what happened was in February, this is the 3-month chart. Here, starting in February until March, the United States set a record oil production. We produced 13 million barrels of oil in February alone. And what this did, setting a new record for us, it pissed off Russia and Saudi Arabia and OPEC. And as you can see, from the end of February coming into March, oil price has absolutely tanked from about $46, $47. It was higher in February, $53 towards the middle of February, all the way down today. Futures are at $29.01. And so the reason why they're doing this is that they're wanting to drive the prices down and get the U.S. out of the oil market. The United States is a high-cost producer of oil compared to Russia, Saudi Arabia, OPEC, with oil futures trading at $29.01. No one can produce that cheaply. Russia, Saudi Arabia, the U.S., none of us can produce that cheaply. And the only people that can produce that cheaply are in war zones like Iraq, Afghanistan. They can produce this cheap. But their socioeconomic status and being in war and terrorism, all that keeps them out of the market. So this is causing turmoil on the market too, because the U.S. oil companies are really struggling with this price. But luckily, most of them have their oil hedged. So they're hedged against price risk. And as long as we can get these prices back up, we should start to see recovering in the oil sector. But if oil stays this low, then U.S. oil companies are going to have to start shutting down production, and we'll see the small ones start to file for bankruptcy. So what Trump is trying to do, buying oil and put it in our strategic reserve, is first of all to save money, because when oil's low, you might as well buy it, and he's going to buy it and store it for later on. When oil prices are high, he can put it onto the market at a lower cost. But also, he's wanting to artificially raise prices to help U.S. producers and to take supply off the market. It's basic supply and demand. Now, can he buy enough? Can the U.S. government buy enough to do that? We'll see. It just depends. But if you take a look at the 5-day, you can see just about exactly where on Friday Trump announced that he was going to start buying oil. You can see the oil prices trading way high. And what I would assume, I'm not sure, is once they start doing that, here comes Saudi Arabia and Russia pumping more supply out onto the market. And again today, he announced that he would, that in about 2 weeks they would start buying oil, and the price came back up a little bit. Let's look at today. Yeah, so around here is his speech, and it went back up and then came back down, and it's trading up. It was down around $2.88 on the futures, but it's come back up now. It's trading at $29.18. So, with all that being said, let's take a look at some stocks that I'm saying we should stay away from. So, we should stay away from the banks. They were the worst. They were the hardest hit today, and the reason why the banks are struggling is because of these lower interest rates. So when the Fed lowers the interest rate, that lowers the amount that banks can charge to you or to businesses for taking out a loan. So whenever they do that, that means they make less money off of each loan. So less profit overall. And that's what drives stock value. So on the 3 months chart, this is for regions. You can see it's pretty flat, up around $29. And as we're coming into March, here's the first. There was a reduction in the interest rate around here. And then now, as you can see, the bank prices, especially after the full point drop in interest rates on Friday, have absolutely tanked. If you want to take a look at Bank of America, same thing. Trading around $35. Now it's at $20. They've lost $15 in value. Let me take a look at Wells Fargo. They were trading around $48. They're now at $26. That's a $22 drop. Now you might be saying that this is a good time to get in. It's good value. I wouldn't jump into banks just yet. Let's wait and see how long this takes. I would wait out probably a month before I got into the banks. Because even though the interest rate's not going to go back up in a month, you might start to see more people getting into the housing. And as the stock market starts to improve, banks should start to go back up. But I'm holding on banks. Do not get into banks yet. And if you look at JP Morgan Chase, they're trading about the same, $27. They're now down to $24. So they actually haven't had that bad of a drop. But they've got their credit cards that are probably holding them up a little bit. But you can still see these huge drops. And these are all 3 month charts that we're looking at. So now these next ones are the stocks that I'm saying maybe not buy tomorrow, but watch very closely. So we're talking about the airline stocks. So I wouldn't buy them yet, but they're deeply, deeply discounted. American Airlines, if you look at their 3 month, they were trading up around $30. Now they're at $15.92. That's half price. Half price. That's like getting half price off your favorite clothing brand or whatever. You're getting these stocks for half price, except they'll make you money. And the reason why I'm saying that they're a good buy is because the president announced today, let's look at American. American was kind of up all day today for some reason. So let's look at United Airlines. Look at here. They were trading at $90. $90 on January 17th. Today they're down to $35. That is a 60, let's just say 60% off. Almost 66% off. Pretty close to it. That is absolutely insane. So if you look at their one day for today, once again, here's Trump's speech that he was giving. And what helped out the airlines is that the airline union proposed a bill of $25 billion in grants for passenger airlines, $4 billion for cargo lines for short-term relief. And they're also asking for loan guarantees in long-term. And if this coronavirus thing continues, they want to see some type of tax relief, to try and cut down on their expenses and their cash outflows. So the president today said that he is not going to let the airlines fail, and that they were having a record year before the outbreak, and now they're on the verge of bankruptcy, and he's not going to let them do that. So just by him saying that today, let's see, United stock price went from 33 up to 36, jumped $3 just from that. $3 from that. So let's look at Delta Airlines on their one day. It's trading at 34, jumped to 37. Another $3 jump. And Southwest, they were down around $36 and jumped up to 38. $2 and some change. And we can go back to American, see what theirs did. They were trading up all day. It's about this time, $14.53 up to $16, $1.50. About $1.50 jump. But if you're looking at percentages, American is a lot cheaper than others. But let's go back and look at Delta's 3 month. They were trading around $62. They're down around $35, almost 50% off. And if you look at the 3-month for Southwest, they were up around $60. They're now at 37. So they're about 20% off. So when you're looking at these airlines, you know, first of all, the government is going to bail them out. It's going to happen. And that's the good thing. So what I'm thinking is that within the next 2 weeks, the president will announce something to help bail out these airlines. And that right there is going to, just from today, just looking at what happened today, you know that that's going to be a huge boost to the airlines. I mean, they were going up $3, or, you know, if it's valued at $30, $3 bump, that's a 10% increase. Just from him saying, yeah, I'm going to take care of them. He didn't announce anything. He just said he's going to take care of them. So, that being said, whenever the president does signal or begin to signal that aid is on the way for the airlines, I say buy, and buy as much as you can, because these airlines are deeply discounted and they're not going anywhere. They might be in trouble right now, but when the aid gets there, or whenever it starts to be signaled that's coming, you believe me, investors are going to dump lots of money in these airlines because they're safe investments, and they're so deeply discounted that you can buy a lot of shares of them right now for pretty cheap. And I think it's a good opportunity to buy low and either hold the stock for later, or you can buy low, and once this aid is announced and it spikes up and kind of starts to flatten, then sell. There's no telling the returns you can make off of it. If it jumps 10% by him just saying, yeah, I'll help him out, you know, I'm not going to let him fail, there's no telling how much it's going to jump whenever he actually announces aid for the airline. So there's a lot of money to be made. A lot of money to be made. And I say buy airlines, not yet, but do it whenever he starts to signal that something's coming out. And I think it should be within the next 2 weeks. Okay, and one last note. One thing I'd like to say. For people who think that we should completely close the markets, or people who think we should halt trading entirely, the markets are the epicenter of the free world. Markets are always trying to be in equilibrium. They're like two magnets pulling supply and demand together until they connect. Are the markets acting irrationally? Yes, they're acting very irrationally, and it's because of an extraneous force. The coronavirus has come into the market. It's not a problem with the market like we had in '08. The markets are fine, but there's extemporaneous force that is pulling on them. And due to their irrationality, the closing the market in the short term would protect your investment, yes. It would protect it while they're closed. But as soon as those markets open back up, your money would not be safe. It would be gone faster than you can say sell, faster than you press the button on your app or your phone. However you do your trading, your money would be gone. Maybe not all of it, but you would lose a big portion if we close the markets. And the reason I say that is because currently we're having a liquidity issue, and that's why you see these big sell-offs, is these companies that are shutting down and losing money, they're having to sell off stock to cover their expenses, and they need cash. So if you close the markets, it's basically closing off their line of credit, their cash. And if they lose liquidity for a certain amount of time, as soon as these markets reopening, those companies are going to sell off a big bulk number of shares to be able to generate the liquidity they need for the entire time that the market was closed. So it's just like, say something happens, your bank account gets hacked and you lose access to it. And that whole time you're getting billed for your rent, your mortgage, your car note, water bill, electric bill, whatever. All your bills are piling up. And then all of a sudden you get access back to your bank account. That day you're going to take out whatever money you need to take out of your bank account to pay off all your debt. And that's exactly what would happen if they closed the stock market. That day it reopens, they're going to sell off everything to pay back their debt that's been accumulating over the time that the market has been closed. And what would happen is other investors that are well versed in the markets, they would see this coming and they would also sell their stock to help protect themselves against this large sell-off. Either they sell all of it or part of it, they're going to sell something to protect themselves. And the people that are going to get hurt are people who use passive investing sites or people who have money that just sits in 401ks or other investment portfolios that are not actively monitored. So without just you put money, kind of like some people have ETFs and various other portfolios that they just put money in every month and they don't look at it. They just let it keep buying whatever they have it set to buy, and it does its thing. Those are the people that are going to be hurt. So with that being said, please stop suggesting that we close the markets. This might help in the short run, but in the long run, it'll be much worse than any natural movement in the markets. But anyways, guys, that's going to be it for me today. I hope you enjoyed the video, and I'll see you guys tomorrow in the next video.